Okay, it's Monday, February 22nd, 2021. And this is your weekly look at the latest Altos Research data that came in over the weekend for the entire US real estate market. Each week, Altos tracks every home for sale in the US, all the pricing, the changes in pricing, the supply and demand, so that you can see the trends in the US housing market far before it becomes available through the traditional media channels. If you missed our webinar last month, 2 weeks ago, the replay is now available on the YouTube channel. We spent an hour looking at all the data and looking at this crazy crisis of inventory shortage. We looked at some of the local markets and talked about what you can expect for the coming year. So go check that out if you missed it from earlier in the month. And we'll have our March webinar coming up in a couple of weeks. Starting with prices this week, median home price in the US is just a hair under 350,000 this week. It's up 10% year over year on average. The year over year pricing is going to jump in March when we get the first of our pandemic year over year comparisons. Home prices this year will very quickly surpass their summer seasonal peak of 2020. The price of the newly listed cohort is 335,000 this week, right in the middle of its normal seasonal launch time. This is going to climb through the end of March for sure, and it's one of the signals where we know that transaction prices are going to remain elevated for several more months at least. We've been doing a considerable work lately trying to help people understand the inventory crisis that we're in. This is not just home buyers and sellers, but also like the big financial institutions, real estate professionals. Everybody's trying to really understand why and where it's going. We have this record shortage of homes available to buy. This week, the trend chart of our inventory crisis dips again. We're down to about 337,000 single-family homes on the market. As I've been pointing out lately, this number is partially reflective of demand that's so high that thousands of listings are getting offers so quickly that they're bypassing the active market altogether, and they're just showing up in the pending contract stage. But if you're a home buyer today and you walk into the market and you look around, 337,000 homes is all you'll see. We have been starting to get a few more listings each week, but we've not yet seen this normal seasonal trough in inventory, which we would normally get across February. Fingers crossed that we see some supply come available in March. I've been getting asked actually a lot lately if the tight inventory conditions might be a function of like realtors conspiring to hold back inventory or otherwise like trying to manipulate the market. What we can tell in the data is this. So there's intense demand, and that definitely gives rise to more of the so-called off-market transactions where like a listing agent is able to get offers before a property is listed for sale. And that obviously keeps the active market numbers lower. But these transactions are really more the result than the cause of the current crisis conditions. Like demand is so high that the seller is able to maximize price without the hassle of showing off the house. So at the end of the day, the cause of this crazy inventory crisis is low interest rates. And it may be counterintuitive, but our ultra cheap money is both the driver of increased demand as well as the decreased supply. So this is the 30-year fixed mortgage rate over the last 13 years. Since 2011, the average rate is only 4%. And the accelerated demand of the last couple of years has been tightly correlated with this declining steep decline in the cost of money in that time. So rates are at 2.8% this week. And that actually means that payments are lower now than they were a year ago, even for a house that gained a ton of value in that time. So in general, real estate got more affordable this year. So home buyers obviously know this and are acting accordingly. So low rates driving demand. What's less obvious is that home sellers, or actually homeowners, know this too. And when rates are so low, it becomes very inexpensive for me to keep my first property for investment income when I go to buy the new home. So this phenomenon of homeowners doubling up, buying but not selling, couple that with big institutional investment over into like single family rental properties over the last decade, is the reason there's like 7 to 8 million homes that used to be like in the resale market that are now shifted into the rental market and no longer available to buy. So as long as rates stay this low, the phenomenon is going to continue. What you might notice is, I like to point out this spike in 2018 from 3.5 to, or 3.7 to 4.8% in the latter half of 2018. That was after this spike of rates was the last time we saw year over year inventory climb. So this year, if rates climb from here 2.8 to over 3, 3.5 or so, that's likely when we'll finally see some breather in this crisis. As the market mania heats up this year, this is one of the charts that we're keeping our eye on. This is the percentage of active listings with price increases. So the percentage of homes that are on the market that have increased their price recently, like 90 days ago, were on the market for a lower price. Normally, the March is the seasonal peak. You can see February and March, here's our year over year data. Normally March is the seasonal peak for price increases. These are like flips or other marketing moves as they're coming to market. They were previously on before. March is the sort of the strategic peak time for listing in much of the country. The best stuff comes on sale for available for purchase in April, May, June. And normally 2 to 4% of the market is this kind of transaction. A year ago, as demand heated up, we were already above 4%, so 4.2% this time last year. Then we had this dip in April with the onset of the pandemic. And then the market came roaring back and demand came roaring back. And now all of a sudden, properties that were on the market here in April lower, they said, wow, demand is here. We're going to relist at a higher price. And that's what we had here. We have our seasonal peak in around the holidays, and then our seasonal dip around the holidays, and then resumption in January, February, first quarter of the year. So this right now is at 7.4% of the active market has increased their asking price. Some markets are where investor speculation is so high. This number is pushing 20%. 20% of the listings are in some kind of price increase, investor flip mode. It feels unsustainably hot. It's frankly worrisome to me. So for those of you who are keen on paying attention to the leading indicators of demand and whether pricing is going to finally back off, this is one of the insightful stats to keep your eye on. If the 30-year mortgage starts climbing over 3%, we'll make sure to revisit this chart and see the changes in demand. So when the demand starts backing off in the market, the very first thing that comes down are the properties that are price increasing. And so we'll see it as an early leading indicator on demand shifts very soon. Okay, that's the data for this week. As always, stay tuned to the YouTube channel for the latest on the data. If you are a real estate professional and you're working with buyers and sellers, trying to communicate what's going on in this crazy market right now, I recommend you go over to altosresearch.com and just book a demo with us, take a look at the data, figure out how you can use the data in your business to help people understand what's going on and make the best decisions. There is a link to Altos Research in the description below. As always, more next week.